Well, my first response to that would be, how does that feel or what? Well, it sucks. So first of all, we'll say that that's not great for the consumer. Okay.
Right.
So I'll also add that unfortunately there are things that none of us have any control of. Right. I sadly don't have control. People often don't have control of whether they're going to have a heart attack tomorrow. We don't have control whether somebody's going to run an intersection and T-bone us either. There are variables we just simply can't control in life. Now, is this overly common? No, it's not overly common. And generally, respectfully, there are probably other considerations there that are dictating that. It's not just random and haphazard. Every once in a while, it is across the board. A certain bank is trying to mitigate their exposure. And that's a more complicated conversation, but they're trying to mitigate their vulnerability or exposure. Okay. But as a rule, they're not doing it for no reason. It might mean that they've done a soft pull and realized that you've got a number of cards that are close to being maxed out. And so therefore the probability of somebody defaulting goes up significantly and they want to mitigate that risk, okay, or their overall portfolio exposure, et cetera, et cetera. That being said, I would be lying to say that even though I am clearly, as you know, a very big advocate for the strategy of velocity banking, and I think it can be a great, great tool or sort of an arrow in your quiver in the battle of trying to mitigate interest and pay off debt. I personally am not a massive fan of leveraging that strategy through credit cards. Now, that's one of the reasons, but there are lots of reasons. Can people do it effectively? Sure. There's a scenario or an exception where people can do a lot of things or almost everything effectively. But in reality, I would say on a personal level for me, um, I've seen it work. I know a number of people that have done it. I would never tell somebody that they shouldn't or that it's across the board bad idea. I wouldn't say that. But I would say that unless you're extremely judicious, you're extremely disciplined, extremely methodical, and so forth, and you have a particular card that doesn't have strange fees or you have other things that are going to make that prohibitive, that could be an exception. But that is an exception, not the rule. As a rule, I am not really a massive advocate for leveraging the strategy through the use of credit cards. Now, as an example, could they reduce your limit on a line of credit? Yes, but at least as it relates to home equity lines of credit, since the collapse back in 2008, they at least have to give you notice in advance. Now, credit cards don't because they have a lot more exposure. There's a little bit different rules there. And because, bear in mind, a credit card is unsecured. So there's, banks in theory developed a contractual relationship with a home equity line of credit, et cetera, where they have some security because it's predicated on being backed by the house. And there were some safeguards built in there because back in the day during the financial collapse, and this happened to me. I had a number of properties, a lot of investment properties, didn't like to have a lot of debt, used a lot of cash, and went to use a couple of lines of credit for some investment purchase opportunities. And the banks were like, oh, yeah, sorry, we closed that a month ago. I didn't even know that it had already been closed. It wasn't like they told me it was closed without even giving me notice. They never even gave me notice. They never even told me. So there was some reform that took place there as a result of Dodd-Frank and all this other stuff. So they have to give you, depends on the state, but 30 to 60 days notice on that. Credit cards, that doesn't apply. So again, although I want to be clear, what you referred to is not something that happens regularly. It's not like across the board. They're just randomly reducing people's lines or available credit limits on credit cards. There are usually other factors there. Maybe they had a late payment somewhere in the past, or maybe they have a lot of other cards that are at or close to their limits. Their utilization ratio is very high. Or it could be that a particular bank, again, is trying to mitigate their exposure. So as a result, I would just say that I'm not saying people shouldn't. I'm not saying that it can't work, and I'm not saying there aren't those that do. Personally, though, I'm not necessarily a big advocate for people utilizing credit cards to facilitate the velocity banking strategy, which is again exactly why we developed our uh, debt elimination and equity acceleration platform, our guidance system, our financial GPS, because it's able to help serve that goal probably even more effectively by being able to monitor and manage exactly which debt to pay off, how much and when, sequentially, to pay the least amount of interest, to pay the most amount of debt, and therefore help you build equity faster, even in a downward declining market.